Good afternoon. Welcome to my March Madness special edition of Wall Street X's and O's. Hey, this is Craig Modelmog for Cornerstone Wealth Management. Today is Friday, March 18th. As you can see, I have my celebratory college game day State Farm net hat that I actually have a couple of these. I went to college game day. I've been there twice now at Allen Fieldhouse at the University of Kansas. And every March Madness, for those of you joining me for the first time in my March Madness special preview, I always wear my net hat. For those of you that come in my office, you can see it. I have two of them. I love them. So you will have to put up with me today doing the entire show wearing my net hat. You got to love that, right? You got to have a little fun. It's Friday afternoon. It's been a crazy week. It's good. Both my kids were home. Sent one back today after digging her out of a snowdrift west of Lyman. Thank God she was not injured and her car was not injured that badly. So she was able to drive back today. But I've been back and forth to Lyman twice, once yesterday, once today. So if anyone needs me to go to Lyman, deal with it. I'm not coming to get your tail. I'm kidding. Anyway, kick things off today. I've got a great show, but we've got to hit our normal disclosures. Obviously, all of the information that is on this show is believed to be true. It is not an offer or a solicitation to buy and or sell any investment. This is not investment advice. It's not tax advice. It's not legal advice. Investments can and will lose money. And without further ado, we're going to crank this off. I'm excited to be here today. Top three things. We're going to do a quick overview on the Fed Chair Powell's commentaries this week, along with the much telegraphed 25 or quarter% interest rate hike that we saw. We're going to talk about the differences of deflation versus disinflation, because this is important. And as these comparisons begin to play out, that is also going to dictate how not only the economy, but the stock market and the bond market, particularly the credit market, which is corporate debt, is going to handle all this. And I'm going to give you a quick update on inflation, oil, Russia-Ukraine challenges. And then we're going to close it out again with things that make you go, And as you can see, for those of you who are joining me for the first time, this is uncut and unedited, and my phone is ringing, and I don't know who it is. So if it's you, you were the special one that interrupted my show. Don't worry, I'm unoffended. Anyway, let's get to number one here. Fed Chair Powell, big speech this week, speaking to reporters, kicked interest rates up by 0.25%, which is exactly what they've been saying they were going to do. Here's what's interesting. If you look at the Fed Fund futures, you say, Craig, what the heck is that? It basically tracks the anticipated price movement or at a particular date going out monthly of what the Fed Fund futures, which is the overnight lending rate, which is one of the shortest lending rates, if not the shortest, which is what the Federal Reserve uses as one of their tools to raise rates and decrease rates, okay? So they kicked it up 0.25%. There are 7 to 8 more rate hikes that the Fed Fund futures is planning just for this year. I think they're going to get 2 at the most, and I'll elaborate on this here as I get going. But what I found really interesting during Fed Chairman Powell's presentation, I was going to say performance, but I didn't want to slam or slight Fed J. Powell. I actually like the guy. I think he's got great intentions. I just don't think he knows what he's doing, or he's challenged at best. He's a Wall Street guy. He's not even an economist, if you can believe that. So I actually think he's kind of got a little bit different lens that he looks through. But what I found interesting was he was really talking about the tools, the committee's tools that they have, this fabulous set of tools. When I think of tools, I think of flashback, Fast Times at Ridgemont High, when Spicoli wrecks Jefferson, who's the big football superstar's car, and he says to the little brother of the superstar, you know what, and I'm going to give my best Spicoli impersonation here. Dude, don't worry. My dad's a TV repairman. He's got a great set of tools. Fed Powell is saying the same thing. Probably not as eloquently as Spicoli did on Fast Times at Ridgemont High, but you know what? The tools are the old wall tools: raising rates, decreasing rates, printing money, spending money, giving money away. You know what? Those are not really the best tools out there. What I get concerned about, and I've been talking about this for weeks upon weeks, is that the Fed is going to make policy mistakes by raising interest rates into a decelerating economy. What do I mean by that? We've got GDP, which is the growth of our country right now, going from about 7% to what my numbers are saying down to zero. We've got corporate profits going from 30%, which they were up in the 80s and in the fourth quarter of last year. The economy peaked in Q4 of 2021, in case you were wondering, actually November. If you want to get specific, the NASDAQ, the small caps, and even Bitcoin all peaked on the same day around the 15th or the 21st of November. Well, you've got corporate profits slowing from 30% from a profitability down to zero. Okay, so here, beans, we are also on for the Irish people this week, which I'm a quarter Irish, at least I think I am. My mom's main name is Gilpin, which I think comes from Ireland. You know, my grandpa drank like a sailor, so I'm going to say I'm probably a quarter Irish. But, you know, my Lucky Charms quiz of the day for Fed Chair Powell is, what is the labor market going to be looking like as we enter in the latter part of this year, when the peak cycle was in the Q4 of last year? And then also, are you going to be able to get in that second hike by May, which I know you're pricing in 7? I think not. Moving on, disinflation versus deflation. These are two big numbers, two big terms that we hear a lot. Okay. We hear a lot, and depending on if we are in a deflationary environment versus a disinflationary environment means a big thing, or it's a big deal. So we need to look at the two. Whenever you think of deflation, and we are in a deflationary environment, that means that basically inflation is going negative, okay, which we have a long way to get there, okay? So most likely that is not a near-term thing. Usually when price levels fall in the economy, that's one way of defining it from a definition standpoint. Deflation is when the rate of inflation reduces over time. I would say we are in a disinflationary period right now. Actually, the start of it. My data is showing inflation has peaked this quarter in Q1 of 2022, and as we move forward, goes down in a very slow march downward over the next couple quarters. Okay, if you look at the frequency, this is another comparison point from deflation. Deflation occurs very rarely and is only compared to disinflation. Well, duh. Disinflation is a much more common occurrence. Deflation doesn't happen often. So whenever you hear something on the news saying, well, deflation, well, perk your ears up, but listen, because we haven't been in very many deflationary environments. It's more disinflationary, which is a slow decline in inflationary levels, okay? Let's look at another way to measure it. Deflation may lead to recessions or depressions. Hence, governments usually like to take a lot of action in trying to cut this off or head this off to pass the first signs of deflation, all right? When you look at disinflationary environments, governments often don't take any actions. It's just something that they see the economy going, and it's something that doesn't worry about that. So that's something to think about as you see the Fed acting. Right now, I think they're a little bit concerned about the inflationary levels, and they're trying to raise rates to slow inflation. I don't think they have the courage to go as many rate hikes as they are planning, because that would put us into a recession. And right now, no one can handle that. Let's look at another one here. During the Great Depression in the 30s, there was double-digit deflation, meaning prices were going down so fast that they were declining in double-digit terms. If you also look at Japan, they had a huge property bubble in Japan in the 1990s, and Japan suffered some serious deflationary challenges. Disinflation, almost every country goes through it over time, and it's really not that huge of a deal. How do stock markets handle it? During a deflationary period, stock markets generally perform very, very badly. Government treasuries tend to perform very, very well, and corporate credit tends to perform very poorly. Disinflationary stock markets may not perform that badly during disinflationary periods. So again, big contradiction as far as how did the stock markets. Bond markets, I mentioned it a little bit, but usually due to central bank policy being very favorable, bonds tend to perform very well during deflationary periods. Why? Fear is high. What happens when fear is surrounding us? Fear runs towards the highest quality things. U.S. dollar, U.S. government treasuries. Disinflationary, central banks are likely to reduce interest rates. What are they doing right now? Raising rates. So we're not in a disinflationary peak from a standpoint of a policy standpoint. We are seeing it in what is happening in the values of all the different commodities out there. The softs specifically, energy, not so much, but I still think we're going to see that roll over. Bonds tend to deliver above average performance, so that's a positive. The impact, deflation is very destructive, usually accompanied by rising unemployment, Q, as well as a slowing economy. Are we getting those right now? Unemployment, no. Slowing economy, yes. I almost flipped the bird on that one. That was close. Dang, that would have been bad. I would have gotten lots of trouble. Tanya would have gave me the shamey, and Lord knows what my mom would have done. She might be waiting for me when I get home tonight. So anyway, I'm glad I didn't do that. Disinflation. As long as inflation is positive, which it is, deflation is not considered to be generally negative. So again, we're kind of in that, but these are just good things that we have to watch and look at and see what happens. Supply and demand. Under deflation, supply tends to be outpaced demand, which is kind of what we don't have now. We've got demand very strong. We've got supply chain issues. Under disinflationary, demand and supply tend to be very similar, so we don't have that problem right now. Unemployment level, as I mentioned, during deflation, you usually see unemployment continue to rise. During disinflation, we usually don't see that. So these are just things that I look at, that I watch, that I track to see what is really going on in the economy, which then helps me front run from an asset allocation standpoint, meaning I try to get out ahead of these economic changes based on what we own, based on the data, based on the math, okay? Inflation update. Again, inflation I really do see peaking during this quarter. What is a big component of inflation? It is oil. Obviously, oil's been crazy, although it has come off its highs significantly. What did oil close at today? Oil closed at today. WTI, which is the light sweet, which is the U.S. crude, closed at 103 spot 28. Brent, which is the international value of oil, closed at 107. So oil is still very elevated. And as I mentioned the last show that was on, every time we've had oil go up by more than 50%, 11 out of 12 times that's happened, we've been in a recession. So there's a lot of really big challenges that are going on out there. When you look at Russia and Ukraine, we've got Putin smoking the peace pipe this week. Smoking on the peace pipe. I'm really not thinking Putin is anything about peace. I hate to say that. Regardless of what happens there, the Russia-Ukraine crisis is only a catalyst. It is one of many. All right, the economy was already decelerating. Inflation was already showing signs of rolling over. In fact, it would have had Russia not invaded Ukraine with oil exploding. But again, that's just one of many catalysts. It's not the only thing you look at. What I find is that lots of us, including a lot of the media and lots of economists, they pick one thing to look at. I heard a lot of politicians talk about, well, the only reason oil is going up is because the Soviet Union invaded Ukraine. That's not correct. Oil was already elevated, all right? This just has accentuated the pricing. So you can't peg everything to just one instance. Don't do it. You can't do it because you know what's going to happen? You're going to be wrong, okay? Moving on here, and these are things that make you go, and with that said, I'm really elevating my game today. I'm going to play some tunes, and this is the song. Okay, so we're going to jam to some tunes while I am going over things that make you go, okay? I'm going to jam here a little bit for a minute. Oh, I love this song. When I was a teenager, I really liked this song, and it really hits home today. So I've got some tunage to come in. The 2020 Census Bureau came out with a huge snafu this last week, if you missed it. And they said that, in fact, the New York Times is one of the bigger ones that covered it, and it says that there was a huge undercounting of Black and Hispanic and Native American residents and an overcount of white Americans and Asian Americans to the count of 19 million people. Okay, now that was quickly recounted because that was false. I might turn this down because I'm kind of jamming a little loud here, like I'm not on the screen. But they said they undercounted nearly 19 million people. Whoops. Missed 19 million. Our bad. Holy crap. Isn't that hilarious? Actually, the Census Bureau then reported, so they were correcting, said, oh no, we didn't miss 19 million. We miscounted 18.8 million, of which we double counted around 5.2. We wrongly included another 2 million, and we missed a whole bunch of others. I find it incredible how our Census Bureau, when you get to elections, I opened a can, I know. I don't know how we cannot fix these things with the technology we have at hand. It shows you we're just using old garbage. Anyway, moving on. Young people, workers entering the workforce, there's a chance they will not be working out of an office. For how long? Who knows? I don't think it's a forever thing. But I found it interesting how they said they talked about, we've got many young people that over the last 2 years during the pandemic, as they enter the workforce, they've never been in their office. They've never met their manager. They've never chatted with a colleague at the water cooler or the coffee pod, which is where I was used to hang out. I was pounding coffee way back in the day, actually not too long ago. And they don't even know what some of their colleagues look like. I think that's crazy. What I find it interesting in all these surveys is that in 2020, 69% of adults under 25 said they would rather work remotely. Another survey conducted in 2020 said that youngest respondents from age 18 to 34 said that they were most likely to be more productive with a flexible work schedule. Okay, I get flexible work schedules. More than, and then 60% said that in addition, they want flexibility in the amount of time they spend in the office. They said they would like a kind of a 50-50 type of split. But what is interesting is that they are finding in the last 2 years that this home work life balance is a train wreck, and that people are experiencing more things about burnout. They are being more closed off, and all these bad things that impact us mentally. So as we normally see in America, the pendulum swings widely. We're seeing the pendulum swing to, oh wow, we can work at home and this is the best environment. It's going to swing back. We're going to find somewhere in the middle because that's what usually happens. Lastly, things that make you go, we're going to do some March Madness statistics because I love March Madness. This is one of the best. For me personally, one of my favorite time of the years. I love basketball. You can see I have my honorary Rock Chalk Jayhawk. Yep, we opened up the can on Texas Southern last night. I thought that's anything to write home about, but at least we showed up and really played well. But if you look at the last, we're looking at upsets. So this is a way to help you predict more upsets, or how many upsets should you predict. So if you look at the last 36 seasons, why is it 36 seasons? That's when the number of teams that were invited to March Madness expanded to the 64-team field. Okay, it says normally there's between 10 and 16 upsets in the NCAA tournament. The national or the annual average is 12.4 upsets. It says there's been as few as 4 upsets back in 2007, and as many as 19 in 2014. The sweet spot's around that 12.4. Okay, there were 18 upsets in last year, so you got to love that. So the kickers, how many upsets should I pick? Well, the average, if you really want to get aggressive, you would try to pick 12 to 13. If you want to get more conservative, 9's kind of that happy median, because there's only been a few times when there's been less than 9 upsets. But if you go round by round, and I'm going to shut this down for the week, total upsets on average is 12.4. The least number is 4, the most is 19. First round upsets, 6.2. Second round upsets, 3.7. Sweet 16, 1.7. Elite 8, 0.5. Final 4, 0.2. So as the tournament goes on, stick with the higher seed. There you have it. Wonderful net hat from State Farm and all right at the end of the song. And I am Craig Modelmog, March 18th. Wall Street X's and O's. Happy Friday. Enjoy some basketball with your loved ones, and I